Big gains are fun until the IRS shows up. You bought some crypto early, you held through the chaos. One day your portfolio finally reads 7 figures. You sell a chunk, feel like a genius, and then your accountant emails you, "Hey, congrats. Also, you might owe $300,000 in taxes." Meanwhile, you see the ultra-rich moving millions in crypto, real estate, and stocks, and their tax bill looks tiny. How? What are they doing that you're not? To understand their playbook, you need to know one thing. For tax purposes, the IRS treats crypto as property, not currency. That means anytime you sell for dollars, trade one coin for another, or even just buy a coffee with crypto, you've created a taxable event. If you held for less than a year, you're paying taxes at your regular income rate, which can be brutally high. More than a year, and you get the lower long-term capital gains rate. And the old idea of flying under the radar? That's over. A new tax form, the 1099-DA, means the IRS is getting a direct report of all your digital asset sales from brokers. So rich investors don't try to hide. They ask a different question. Given that everything is on the grid, how do I use the rules as written to keep more of my money working for me? This isn't about tax evasion, which is a legal hider.
It's about tax avoidance, legally using the tax code to your advantage. Here's the first and simplest strategy. The rich sell without selling. They borrow. Imagine you have $1 million worth of Bitcoin. Instead of selling it and facing a massive tax bill on your gains, you pledge that Bitcoin as collateral for a loan. You borrow, say, $300,000 in cash. From the IRS's perspective, you haven't sold anything. You still own the Bitcoin. Taking out a loan isn't income. Now, this isn't free money. You pay interest, and if the crypto market crashes, your collateral gets liquidated, forcing a sale at the worst possible time. But it's a powerful way to get cash without triggering an immediate tax event. But the second strategy is where it gets really interesting. It's something most people have never heard of, the Charitable Remainder Trust, or CRUT. It's a way to sell tax-free now and get paid slowly over time. Here's how it works. With an attorney, you set up a special, irrevocable trust. That means once you put something in, you can't take it back. Then you donate your $1 million of appreciated Bitcoin to this trust. Here's the magic step. The trust sells the Bitcoin. Because it's a specialized charitable entity, the trust itself generally pays 0 capital gains tax. So instead of you selling and maybe having $700,000 left after taxes, the full $1 million stays inside the trust, compounding. Then the trust pays you a fixed percentage of its value every year as an income stream, maybe 7%. You pay income tax on those payments as you receive them, but you've avoided the giant one-time tax hit and spread the cost over decades. When the trust ends, usually at the end of your life, whatever's left goes to a charity you chose. That's the deal with the IRS. So why doesn't everyone do this? Because it's complex, permanent, and under heavy IRS scrutiny. It's not a weekend project, it's a serious legal structure for people with millions in gains who are already charitably inclined. It shows that for the wealthy, tax planning isn't an afterthought. It's a core part of the strategy. Using the rules of the game to ensure the big win isn't just about making the money, but about keeping it.
But the third strategy is where the real game is played. It's about planning before the bull run, not after. While most people are scrambling to figure out taxes once their portfolio is up 10x, wealthy investors have already asked themselves a simple question months or even years earlier. If this goes to the moon, what will I wish I had done ahead of time? And the answer usually involves 4 key moves. First, structuring where they hold their assets. They're intentional about putting certain crypto into tax-sheltered accounts like an IRA, where gains can grow tax-deferred, or in a Roth, come out completely tax-free. Second, they play the long game. They know the difference between holding for less than a year and paying high ordinary income rates versus holding for more than a year and getting those much lower long-term capital gains rates. If they're at month 10 on a massive position, you can bet they're calculating if waiting another 60 days is worth tens or even hundreds of thousands of dollars. Third, they harvest losses on purpose. When part of their portfolio is down, they don't just hope it comes back, they strategically sell at a loss to bank a tax deduction. That loss can offset other capital gains, plus up to $3,000 of your regular income each year. And here's the kicker. Because crypto is currently treated as property, not a security, the wash sale rule that stops you from doing this with stocks doesn't clearly apply. This gives them incredible flexibility. And finally, number 4, they are obsessive about records. They don't trust their memory, they use software, track every transfer, and document every cost basis.
It's not just to save money, it's to survive an audit. Now, for the most extreme strategy, changing where they're taxed. This isn't for everyone, but it happens. We're talking about moving from a high-tax state like California or New York to a place with no state income tax like Florida, Texas, or Wyoming. For a multi-million-dollar gain, that move alone can save you 6 or 7 figures. It's a life decision first, a tax strategy second, and absolutely requires professional planning. So let's put a face on this. Meet Alex. Alex put $200,000 into crypto. After a monster bull run, it's worth $1.2 million, a $1 million gain. If Alex just panic sells everything, the tax bill could easily be $300,000, a huge chunk of the win gone. But Alex doesn't panic. Working with a CPA, Alex makes a plan. First, they harvest $80,000 in losses from some dead altcoins. That immediately softens the future tax hit.
The trust sells the crypto completely tax-free. Alex gets a big upfront charitable deduction and starts receiving an annual income stream from the trust for years. With the remaining $500,000, Alex keeps some as a long-term hold and pledges another portion as collateral for a conservative loan, getting cash without selling. Over the next decade, Alex gets income from the trust and the remainder eventually goes to a charity. Did Alex avoid all taxes? No. The loan has interest, the trust distributions are taxable, and there are legal fees. But compared to just selling and writing a giant check to the IRS, Alex smoothed out the tax hit, kept far more money compounding for longer, and turned a tax problem into personal income and a philanthropic legacy. So where does this leave you? Don't ignore taxes. The IRS is paying attention and new reporting rules are coming. Get educated on the basics, long-term versus short-term gains, and what actually triggers a tax event. And if your gains are becoming life-changing, talk to a qualified professional before you hit sell. Focus on the legal, sustainable strategies. Long-term holding, tax loss harvesting, and thoughtful use of retirement accounts are all tools in the toolbox. Because in crypto, making money is only half the battle. Keeping it, legally, is the other half.